Hello everyone, welcome back to Upside Down Data. Today we want to talk about something that's a little bit different. It's actually partially inspired by some things that Jay has talked about from Daily Crypto Analysis over at his channel. If you're not familiar with Jay's channel, I highly recommend you go check it out. It's great for data-driven crypto analysis. And Jay and Joe and I from here at Upside Down Data, we've had different discussions that we've posted, and we're also collaborating to put together a website to host a number of our different indicators. So we see Jay as being very much aligned with what we're doing here at Upside Down Data. And so Jay has talked a lot about how, in terms of valuing an asset in crypto, one of the things that's oftentimes useful to look at is not just the price, but also active addresses. Who's actually using the network? How many people are actually using it? You know, with Metcalfe's law, the idea being that the value of a network grows with the number of users who are on it. And I think this is an interesting approach because a lot of the ways that you'll see kind of this idea of fair value be talked about with Bitcoin is this idea of oftentimes you'll see a logarithmic regression line, like what I've done here. It's just basically a logarithmic line fit to the price of Bitcoin. And people will say, all right, this is the fair value, right? So you can see that right now we're kind of dribbling along the fair value, kind of bouncing off of it right now. But a lot of people kind of take this as being gospel for what is fair value or how we should value Bitcoin as a network. You just take its historic price action, kind of fit a logarithmic curve to it and say, that's what we expect Bitcoin to do. And then you can project into the future. You know, next year, you know, if you project this curve out, where will it be? Then what price would we expect Bitcoin to be at, et cetera, et cetera, et cetera. But I think this idea of leveraging our knowledge of how many people are actually using the network, because with Bitcoin being a open ledger, we just can know, we can just look to see how many people are actively using the network at any given point in time. I think there's another way we can try to value Bitcoin, and it's interesting to compare these two approaches together because they actually diverge, and we'll talk about that in a minute. So this, what I'm showing you here, is just what other people have talked about a million times, you know, fitting this logarithmic regression curve across Bitcoin's price history. That's your fair value line. But let's look at the number of active addresses and come up with what I'm kind of calling here a fair number, quote unquote, or a fair number of active addresses on the network. And so the white line here is just the number of active addresses over time. As you can see, it's very volatile, you know, it's a lot of fluctuation, but it also kind of fits a logarithmic trend, right? And so when you fit a logarithmic curve to this data, you get the exact same, you get a logarithmic fit, basically. So that's what you're getting here. But what's interesting to note is that unlike, you know, the Bitcoin's price, when you plot a logarithmic curve to it, the fair value, or excuse me, the fair number of active addresses is actually higher than we're at currently right now. You can see that kind of Bitcoin was kind of on one trajectory for a lot of its life history, or for quite a bit of time. Then it kind of fell off of that into more kind of recent years or recent times. We've been below it for, you know, years at this point, this kind of overall logarithmic curve. And so that's one thing that's kind of interesting. So if you're expecting kind of regression to the mean or divergence back to the mean, you know, the price of Bitcoin has kind of gotten back to its fair value. You know, if you're expecting that to happen with active addresses, we might actually expect the number of active addresses to pick up with Bitcoin over time to get us back up to this curve. Now, obviously, that wouldn't have to happen. We could just continue to kind of go stagnant, and that would just pull this curve down over time. But if this curve is going to have some kind of long-term predictive power, we might actually be a little bit under where we'd expect to be with the number of active addresses, and maybe we'll actually see a pickup over time to get back to what has been this historical trend. Something to keep an eye on for sure. So this is interesting, but you might be asking, okay, but who cares? Right? So who cares how many number of active addresses there are in the network? Can we actually relate to that to price in any meaningful way? And I think that's a good question. And the simple answer is obviously we can relate it to price for sure. And from Metcalfe's law, we think that they probably should be related, right? That the price of Bitcoin should be related to the number of active addresses. So one thing that we can actually just do is simply divide the price of Bitcoin by the number of active addresses and get the number of dollars per active address. And so we can just look at Bitcoin's history and say, how many dollars has it been the case that we've been valuing each active address on the network? So just basically just what's the price of Bitcoin? How is that relating to the number of active addresses? What you can see is we actually get this uptrend over time. where over time, the basically more value has been placed on every single active user in the network over time. So there's a growing number of dollars being ascribed to every single active address, and that's growing over time. And now again, we can fit different curves to this to see if we can kind of get some fair kind of estimate of what the dollars per active address should be. I'm showing you here is a logarithmic function fit to it, a logarithmic curve fit to this data. But one of the things when I was looking at this was that it wasn't clear if this was actually the best fit, right? You know, it looks reasonable. And what it basically would make it look like is that we're valuing active addresses way too highly right now from this perspective relative to what would be expected given past trajectory. But actually, this kind of looked to me like a linear fit could actually work just as well, if not better. And that's what I'm showing you here, just fitting a linear line to this. So just a linear regression line to this data. And in fact, this actually, to take a data-driven approach, this actually does fit the data better. So R squared, if you're familiar with that, that metric, is basically the amount of variance being explained in the data by the different regression equations, essentially. And so what we can see is that basically higher R squared means better fit. And the linear fit actually is fitting the data better than the logarithmic fit. And so for some other kind of analysis I'm going to show here in a minute, I'm going to be using the linear fit just because from this data-driven perspective, it does seem to be the case that kind of in a linear fashion, more and more value is being placed on every single active user in the Bitcoin network. That just seems to be kind of what's happening here. And, you know, one of the things, it kind of makes sense to some degree this is happening because if you think about it, there are a lot of other things tied to Bitcoin that aren't directly related to its on-chain behavior, right? You know, all the derivatives in Bitcoin that also then do have an influence on the price of Bitcoin. And then also, frankly, just all the kind of like exchanges and things like that that hold Bitcoin that aren't people are engaging with the Bitcoin network, affecting the price of Bitcoin network on centralized entities that aren't showing up on chain as being active addresses per se. And so there is maybe some reason to expect that as the network grows, more and more things get built on top of it, and more value gets placed on those things that isn't going to be reflected by active addresses on the network per se. And so this going up in a linear fashion kind of makes sense if there's kind of a linear amount of new stuff being layered on top of the network. Obviously, there'll be other explanations for this, but that's just one of the things that came to mind for me when I was thinking about why this kind of relationship might exist. And it's interesting to note that a linear fit does seem to explain this better. And so what this might kind of suggest, if we kind of take a summary of the data that we just looked at, is that the number of active addresses right now is a little bit under what we might expect given historical trends, fitting kind of that logarithmic line over it. And we also know that the number of dollars being ascribed to each active address is increasing over time as well. And one of the things that's interesting about this is that we can now take these two kind of regression lines and get a different way of potentially assessing fair value. Essentially what I'm talking about here is we just basically take this estimate of number, or this predicted value, this red line, predicted value of number of active addresses on the network, kind of this fair number being the first component, and then we take this fair number of dollars per active address, this green line, and if we just multiply those two things together, we can come up with a different way of estimating fair value on the Bitcoin network, or fair value price rather, for Bitcoin. And this is essentially just the predicted number of active addresses times the predicted number of dollars, US dollars per active address. And so again, this is different than just fitting a logarithmic price curve to the price action. Instead, what we're doing here is we're taking, kind of from a data-driven approach, what is the predicted number of active addresses at any given point in time, given past trajectory, and what is the predicted number of dollars we should ascribe to each active address based on historical trends. And then we kind of are combining those two together to get this. And now this will be different, obviously, than what you're going to get from just fitting it to the price action, right? And you can see that it still seems to be doing a fairly reasonable job of explaining it, but you'll actually notice that from this perspective of this kind of version of fair value, we're quite a bit undervalued right now from its perspective. In fact, we're as undervalued as we were back here in the depths of 2018, roughly, if you just kind of eyeball it, with COVID kind of being the COVID crash being the point of most extreme deviation from this line. And you see these other kind of more bearish phases here Actually, the deepest we dipped at the very bottom of here was not nearly as big as what we got back here as well. So it's a little bit interesting. And we can compare the two directly against each other just to kind of get an idea of how these look against each other. And it is different, right? You can see that there's kind of, less, a bigger dive in these bear markets relative to the red line than the green line. But then now there's a larger dive in these kind of bearish phases from the green line than the red line. It's kind of how these two things are differing from each other. And of course, I think it's an open question of which one of these is better. Obviously, if you're just looking at price on its own, there's some merit to just predicting it based on itself. But I think it is interesting to take this active address idea into account, and especially the idea being that if we're a little bit under where we might expect to be in terms of active addresses, and we might expect a reversion back up to that fair value line in the future, then that could suggest this kind of more favorable outlook for Bitcoin than we're at right now. Because again, we're underneath where we'd expect to be in terms of active addresses based on historical trends. And so that might suggest that from that perspective, we're undervalued in price as well. Now, I want to do this a little bit more formally by just taking this and looking at the exact values of where it would be predicted today, but then also using this as a projection tool to project into the future of where some of these predicted prices and these other values should be based on these logarithmic and linear regressions that I've been showing you. So with this table here, what I'm going to show you is we have these different outcomes. So predicted price from the log price curve model. So that's just simply taking the price action of Bitcoin, fitting a logarithmic curve to it, and using that as your predictor of kind of the fair value across time. Then have the predicted number of active addresses from that logarithmic regression that I had shown you earlier. We have the predicted number of dollars per active address, which is what I showed you earlier, that linear green line. And then we can have different ways of predicting price based on some of these metrics. So this is going to be predicted price. This is basically that second model I showed you for predicting price. So the predicted number of active addresses multiplied by the predicted dollars per active address on the network. And then I'm also going to compare that to just one where instead of kind of using this kind of projection of assuming a linear increase in time of the amount of value per active address, I'm going to show you just kind of maybe a more conservative way of doing this kind of projection, where I'm just going to use the current dollar per active addresses on the network. So assume that never changes going into the future, there is no linear increase, what that would do to predicted price. So let's look at right now where the predicted values would be from these different models. So from that predicted kind of log price model, the predicted value is at 37K. So we're, very close to that right now. Predicted number of active addresses is actually over twice as many as we have right now, which I think is quite interesting. That based on historical trends, fitting a logarithmic curve over the number of active addresses on the Bitcoin network, we would actually predict there to be over 2 million active addresses, whereas there's only 1 million active addresses right now. That's what this actual is, the current actual number of active addresses. So we're well below where we expect to be. And that's where I'm saying that if we do expect some reversion back to kind of the expected value, the kind of fair number of active addresses, we might actually expect Bitcoin to grow from here. And, different things that in the real world could catalyze this, obviously if Bitcoin starts getting adopted in areas where people would want to have their own wallets, where maybe there isn't as much of a kind of centralized infrastructure put in place where people are just relying on those, maybe people would get more of their own wallets, and that would increase the number of active addresses. All sorts of number of things you could speculate. But if we're just going to say that historical trends are going to continue, we're well under where we should be, and so you might expect Bitcoin to rise up to meet that curve at some point in the future. Not to say it has to happen, but it could happen for sure. And then we also have this predicted dollar value per active addresses, and it turns out that the predicted value and the actual value are basically the same right now, just as it so happens, at around 4 cents per active address. So basically per active address, that you'd expect about 4 additional cents to be added to the Bitcoin price. And now we can have our two kind of alternative ways of assessing fair value versus just using this logarithmic kind of model on the price. Here, what we're doing again is we're multiplying these two things together, basically. So just, 2 million times 4 cents. And that gets us to $81,655 as the fair value. And so that's interesting because, again, as we're trading at around 39K, this is quite a bit higher than where we are right now. This is about double where we are right now, which is a very different outlook than this model. And then, of course, if you're using the actual value, it doesn't change much because these are basically the same, so around 81K as well. So that's all fine and good. So that's interesting. We noted this difference before, right? The difference between these two values, which is interesting. But let's look at how this would evolve over time, projecting those models out, those kind of fair value models across time. So if we take this 1 year from now, so where we expect to be 1 year, so with this kind of standard model that a lot of people have talked about, we'd expect to be at around 57K a year from now in terms of fair value. So up about 50% from our current levels. We'd expect to add around a little under 600,000 more active addresses to the network. We'd also expect to increase the value placed on each one of those by about 50%. And so that ends up leading to an overall kind of predicted price from this model where we're just multiplying these two together of $162,800. And you can see how much these are diverging now. 60,000, this is over 100,000 more per Bitcoin this is expecting. And then even if we take maybe a more conservative version where we're not assuming a kind of a linear increase from where we are right now of value per active address, just assume that stays constant, this 0.039 per active address right here, then that would get us to a predicted price of a little over 100,000. So again, still quite a bit up from this model right here. And that would be the expectation of next year. And then if we project out even further, 2 years from now, we see that this base kind of standard model would predict $85,000 per Bitcoin. We're up to 300,000 for this model here, because look at how many more people are going to be expected to be active on the network, maybe more addresses. And then also the fact that we'd expect each active address to be valued even more highly than it is right now. And again, the one rationale for that could be that just as more things would get built on top of Bitcoin, you could have more value being placed on the network proportional to the number of people who are actually active on it, because there's kind of more things involved than just active users on the network itself. That would be the explanation of why that could increase. And then even if we use this more conservative one where we're not assuming that happens, we just assume that we stay at this kind of constant rate of where we are right now, that would still be $128,000 per Bitcoin. So still quite a bit higher than what would be expected from this more standard model. Now, of course, this is all incredibly speculative because really with these models, we don't really know which one's going to bear out in the future, right? We really don't know what's going to happen. But it's interesting to think about this, right, as being an alternative way of valuing Bitcoin, because this version of predicted price really is depending a lot on the number of active addresses. With this price right here, it's kind of ignoring that. It's just kind of pricing that in, just saying that's already being built into the price action. We're not really going to take that into any particular account. We're just going to kind of lump it in with everything else impacting Bitcoin's price and use that whatever trend has existed in history to project out into the future. Whereas this one is kind of placing activity on the network a little bit more front and center and saying that if value from the network is actually being derived from the number of active addresses, which would be consistent with the ideas of things like Metcalfe's law, then it might say that that could be a thing that's really driving the value, kind of this idea of adoption kind of being a very direct driver of price. And the idea being that if we've kind of had a depressed activity on the network recently from what we'd have expected in the past, then it could be this model is actually underselling where we might expect Bitcoin to go in the future, which I think is actually very interesting, because I think a lot, especially right now in such bearish times, if anything, people are saying that even this model is being too bullish. Interesting to think if it's actually being too conservative. Now, again, we don't know if that's going to be the case, but it's just interesting to think. And so it'll be really interesting to watch in the next couple of years which one ends up panning out, right? If we do end up kind of seeing adoption increase and expand, maybe we're going to be targeting some of these kind of values here more than these. Now, again, all of this is kind of assuming that historical trends are predictive of the future, and it could be the case that if we do go into some massive bear market across all markets, right, if the stock market completely tanks and we have a huge financial disaster across the board, then all of this kind of gets thrown out the window, and crypto and everything else is probably going down with the ship. And so, crypto adoption might also take a hit just if financial, everything is tanking. We don't really know. But, assuming nothing like that does happen, or that the historical trends do still have predictive power into the future, this is giving a very different perspective on that. And so I personally just think these are just other very interesting ways of assessing fair value. And so I'm always interested in other ways that we can look to kind of assess fair value from just kind of this model. So I think there's other things that we can look at with Bitcoin that could offer different pictures. And it very well could be the case that people who are just rigidly following this model get very surprised in the future. All right, if you like the content, remember to subscribe to the channel, give the video a like, and follow us on Twitter. Put out a lot of content over there about our risk indicators and more.